impact. Of the big three, they had the most cancellations in terms of a percentage of their daily service. They had over 9,000 flights canceled from this storm. Apparently, it was unprecedented in the carrier's history. And we're not done yet, because we started with a clean schedule for everybody. And now that schedule had assumed we would have equipment and crew where they're supposed to be, and they're not there. So this will be a couple of days to work through. But certainly versus the other carriers, American has been seen a lopsided impact from this storm.
Gotcha. Do you expect to hear some of the other carriers also talk about it, or is it really an American problem, to your point?
Yeah, so I think this disruption is significant enough that I'd be surprised if no one else talked about it. And when I sort of thumb through mentally the FlightAware data, for example, JetBlue was kind of up there. Delta Airlines was also kind of up there in terms of what kind of delays they saw. Maybe Southwest Airlines a little bit as well. But relative to DAL or American, Southwest, let's say they benefit from having a relatively simple operation. They just have one fleet type, and they're almost entirely domestic. So they don't have complicated global schedules that have been seen some dislocation.
And speaking of Southwest, they report tomorrow, right? And they're also just ending their long-time boarding procedure. So what do you think is the future and outlook for Southwest?
Yeah, it's an interesting one. On one level, they have a formidable strategic shareholder that's been making important changes to the boarding process. They have strategically moving towards a look and smell that looks somewhat more like a network carrier. International code shares with different airlines. For example, changing the boarding procedure, no more bags fly free. I think if you're a Southwest, however, relative to the other three, the main thing on my mind is the EBIT to free cash flow conversion. If we think about pre-pandemic, Southwest was doing $3 billion each of EBIT and free cash flow, for example. You look at today's EBIT to free cash flow conversion, it looks really poor versus what it used to. In fact, Southwest has been burning cash, whereas the big three have been generating free cash flow.
Can they get back there?
I think time will tell, how these initiatives play out. I think on the revenue side, it looks like they're on the right path. In terms of getting to more of a look and smell like a network airline model, seat mile cost is going to be the thing to watch over the next couple of years. As they onboard new equipment, maybe there's going to be nuances in pilot salary. Maybe they need new flight simulators, depending if they, assuming they go that way.
Right.
So I think the seat mile cost side of the fence is a big question mark. But the EBIT to free cash flow conversion that they used to have, I don't see them getting back to that. And then an opportunity to lever up, which they're doing. But I think longer term, we have to watch the EBIT to free cash flow conversion for Southwest.
Gotcha. Steve, good to see you. Thanks so much for coming in. Appreciate it.
Thanks for having me.
Well, sticking with the airspace, the latest results from Boeing show the plane maker generated cash for a second straight quarter. Boeing also reported a 57% jump in sales as its recovery continues. Joining us for more, Tony Bancroft, a portfolio manager at Gabelli Funds, covering the aerospace and defense and environmental services stocks. It's good to see you, Tony, as always, to talk about Boeing. I know that you have been a believer on this one, so maybe validated to some extent by some of the numbers here. So what were some of your takeaways from what we heard from Boeing?
It's great to be with you, Julie. I think overall, progress on increasing production, getting the production lines in order, supply chains sort of battened down. And, I think over the long term, you're going to see these certifications, are going to be a big positive for the company. They talked about having both variants of the Dash 7 and Dash 10, which they talked about before this year, certified. And the 777 looks like deliveries are going to end up at the end of this year, hopefully the 777X. So these are all, positive momentum. Some a little bit of challenges still on the defense with the KC-46. It's a new tanker program. They took some charges there. But I'd say overall, it's a pretty good quarter and pretty good report, and looking forward to hearing what more of that to say on the call at 10:30.
Yeah, Tony, and it seems like that accounting change related, or that breakdown related to that tanker program is what may be responsible for the stock going down, given that the other numbers that you mentioned look pretty decent. For people who aren't familiar with that, what is that sort of a legacy of what Kelly Ortberg, the CEO, is trying to sort of clean up? How much attention, how concerned should people be about that?
Yeah, the KC-46 is essentially a new tanker for the Department of War and international international customers, and there's growing pains on every new program, and there were historically some issues with the boom. It's a new technology. How the boom operates much different than the boom that I tanked off of in the F-18. It's much more digital than historically, so more complex, and then some other structural issues, not safety of flight, but just essentially how the manufacturing process. They're working through those. Again, this is going to be a very long. My grandkids could be tanking off of this aircraft in a few years down the road. So I think overall it's probably not a big deal, and it's just some follow-on charges they've been taking on the defense businesses for the last few multiple quarters. But likely that's going to continue to improve. It's one of our largest holdings in our Gabelli Commercial Aerospace and Defense ETF, ticker GCAD. And it's done very well for us, and I continue to expect it will do well over time.
Tony, what do you think is the sort of biggest potential for upside with Boeing? We keep sort of waiting for them to work out the various issues that they've been trying to work out over the past few years. Once they do, is it just that being done that's going to be the thing that's going to unlock more upside for the stock? Or are you waiting for them to come out with some of the longstanding products, for example, they've been working on?
Yeah, I think that's, there's a couple of things there. I think the biggest is people still understand that, they talked about upping the 737, which is the most important program for them, to 42 a month. But still, they're not back where they were, at their previous peak of about 52 a month. And there's a lot of operating leverage that goes into production, as you have all this overhead. If you're producing at under rate, you've got these people working that are not at full production capacity, and you're essentially just paying for a line that's not optimized. So as that starts to improve and you start seeing more throughput, it's just going to increase the profitability. And it's a very simple math problem, like many businesses, and you're going to start seeing the profitability improve, and the growth there on the commercial side, as well as the wide body business, the 787. You're starting to see more throughput there as well. They talked about eight a month, going to 8 a month now, and then the 777X is going to come online, and along with the other variants of the 737. So you're going to start seeing deliveries increase, and then the defense businesses are essentially incrementally improving and getting back to historic margins. So you're going to start seeing a business that was much more what we knew of Boeing back in the mid-late teens. So I think that's sort of the driver. And then the follow-on program. Remember, there is a duopoly, and they have the follow-on programs for the next generation narrow body plane, which at some point they're going to start talking about and working on. And that's all things being equal with the we were seeing the traffic numbers and traffic projections for 2026 and beyond. It's still outpacing, global GDP. So I think we're going to see some good things out of Boeing in the future.
Tony, while I have you, I want to ask you about another potential government shutdown, this one a partial shutdown. But are there any repercussions for defense spending?
I'd say I think that the defense spending, particularly right now, what's going on in the world, is probably a bipartisan issue, and I don't think either side of the house wants to see a holdup in that. I think that what happened last time was not a good look at anyone, and I don't think they want that again. and there's probably a way they're going to be able. There might be a short, a few day delay or a gap there, but I think they'll have a solution relatively quickly, at least on the defense spending, to maintain that going forward.
Tony, thanks so much. Have a good day.
Thanks.
Coming up, results from United Healthcare disappoint as also the Trump administration reportedly makes a surprising recommendation for Medicare reimbursement. Shares of United Healthcare sharply lower after forecasting a drop in revenue this year, which would make its first year-over-year sales decline since 1989. The insurance giant was the worst performing member of the Dow in 2025, falling about 35% over the course of the year. Let's bring in Jared Holtz, Mizuho America's healthcare equity strategist, to talk more about this. And this is before we even get into the reports on Medicare reimbursement rates, Jared. But just when you look at the numbers themselves, what to you holds the most responsibility for not just the disappointing results today, but the weakness that we've been seeing in United Health?
Hey, Julie, how are you? I think it's multifaceted. I mean, some of it is just stemming from prior year disappointments, and so this just adds another layer to that. I think from a sentiment standpoint, that's really important to consider. It's not like this was the first piece of bad news we've gotten for the industry or for the stock. When you look at the quarter, it was actually not so bad. The MLR was better than expected. There were some bright spots to kind of talk about. But then when you fast forward to 2026, which is more important, and then 2027, it just doesn't seem like there's that much upside to numbers. And that was really what a lot of investors were going on into earnings, was that you were going to see some shift in earnings higher and maybe get a conservative guidance with room for upside. And I just think that's sort of off the table near term.
And it seems as though Optum, which had been one of the sort of profit generation engines of the company, and it's sort of a subsidiary of UNH that provides pharmacy benefit services, but other types of services too. It seems like that is now shrinking. Is that also, I guess that's not necessarily unexpected, but is that something that also is going to mean things are going to be slower?
I think both sides of the business, big picture, are shrinking a bit. I think this is sort of United's approach in terms of, getting the overall business to better align with the cost structure. It's been very, very difficult, I think, for so many companies in managed care to predict the future. We've seen some really big numbers misses out of all of them pretty much over the past couple of years. And so it's not that distinct to see shrinking of the business. I think the profitability is okay. But again, when you talk about what needs to happen for the stocks to start working, I think we need to start seeing some real earnings leverage coming out of both pieces of the business, and that's just not happening.
Jared, taking a step back, right? When you talked about MLR, for folks who don't know, that's the medical loss ratio. It's the percentage of premiums that United Healthcare collects that it's paying out to pay for healthcare. And that has been a challenge for it and other insurers. Is there anything that these guys can do, something that would be good perhaps for all of us, to get the cost of healthcare down in a way that would help their margins? Are they working on that at all?
I think they're trying to. I mean, part of the 2026 number is a little bit more hemorrhaging of the patient population that's higher risk. I think the company is trying to downsize in certain areas of the market, which have been either problematic, difficult to predict, all of the above. And so I think that's already starting to happen. The MLR has been very hit or miss. There's been a difficulty or complexity with respect to predicting patient movement and activity. Not just United, I would say for most of the companies in this sector over the past few years. Some of that stemming from COVID, which put a lot more patients into the system following the pandemic. There's some typical demographic shifts, but this has been the toughest piece, I think, of investing in managed care, is that the companies haven't really had visibility. And if they don't, it's tough to think that investors do.
But if they're not covering the sickest people, I mean, maybe it'll be lower cost for them, but ultimately, won't it be higher cost for the system?
It's possible. I mean, a lot of what investors are talking today about is, can United, can they kind of like shrink the cost structure? What can they better do to align revenues and expenses? And part of that is cutting benefits. So I think a lot of the patients on United plans or otherwise are going to see, because of what's going on in the industry, they're going to be paying the same but getting less. I think that may be from a societal standpoint, the most problematic piece of all of this is that you're going to see patients that pay X but get way less than they used to in the past.
That does seem problematic. Jared, and then there is the other big story that we are watching, which is that the Medicare Advantage reimbursement rates are now expected to be less than expected for 2027. How important is that for you? I mean, UNH is a huge company, so I don't know how important on a relative basis Medicare Advantage is. Can you help us understand that and then the effect it's going to have throughout the industry?
Yeah, it's really important for UNH, for Humana, for CVS, and for a couple others as far as, what it does to numbers. I think a lot of the street models sort of implied or assumed that Medicare Advantage rates would go up next year by something around 5%, give or take. And so to see CMS come out and say that they were going to reimburse that category on a flat year over year, it just pressures earnings even more, right? Because the spending at the companies probably, the way that the companies are setting up for 2027, I believe probably assumes some sort of uplift in terms of reimbursement. Now that looks to be flat versus 5%, you're 15 to 25% of the business for several of the companies in this category is going to be impacted. Again, I think the number, it's tough to tell on a true numbers basis for a little while because, these patient populations on a per company basis seem to change a decent amount, but it's going to have a big impact. I think that's why for the next couple of years, even though United, I think, is being, fairly assertive in saying that they're going to grow earnings, I think it's going to have to come from other areas of the business, including cost cutting, to get them there.
Jared, in having this discussion with you, whether it's about Medicare Advantage or about the fundamental business, I think we're all pretty aware that healthcare, the health insurance system in this country is pretty broken. We've had the discussion in Washington before, but it seems to be coming to a head in a different way. But does it feel like anything is going to change here?
I don't think so. Not over the near term. I mean, we talk about the brokenness of the system constantly. It just doesn't seem like there's an outcome that's going to happen anytime soon that allows all of the verticals within healthcare to act well simultaneously. So I think right now what we're seeing is a little bit of a thawing out in pharmaceuticals, arguably, with the drug pricing conversations having been had and some regulations going into place this year. And I think some of the discussion or discourse coming from DC is now squarely on managed care, providers, other segments of the market. I truly don't think there's anyone in the administration that's willing to, or at least has come out publicly and sort of blueprinted a plan that is going to, tackle the issue, recreate the healthcare system, what have you. So I think this is just an ongoing conversation we have.
Is there any reason for investors to look at these stocks?
I don't know. I think eventually, when you get these sort of visceral reactions to, single stocks and multiple stocks within a category, you let it breathe for a little while and then come back to it. It's really going to come down to what is the path for either a United or others in the peer group to sustainably grow earnings and show visibility. Now, I don't think we have that today. I don't think we're going to get that tomorrow. But I think one thing that's interesting is that the CMS Medicare Advantage final ruling will come out sometime in April. And so maybe there's a trade into April where you can go long this group for a little while in, aspirationally thinking that Medicare rates are going to be a little bit better.
Welcome back to Yahoo Finance. I'm Brooke DePalma. Let's turn now to some of today's top analyst calls on Wall Street. We're watching shares of Pfizer, CoreWeave, and Zoom. First up, drug makers Pfizer and Merck & Co. Cantor Fitzgerald upgraded Pfizer's price target to $27, up from $24. It also upgraded its price target for Merck & Co. to $116, up from $83. The analyst maintained its neutral rating, though, on both stocks, and both are set to report earnings next week. Now, ratings on the street are largely mixed. Pfizer has 14 buy ratings, 15 holds, and 1 sell, while Merck & Co. has 21 buys, 11 holds, and 1 sell. Next up, CoreWeave, the stock's move higher continues this morning after Deutsche Bank upgraded its rating on the stock to buy. On Monday, it announced an additional $2 billion investment from NVIDIA, and the analyst said that incrementally strengthens their longer-term view and further validates its technical leadership. There are now 18 buys, 13 holds, and 2 sell ratings on the street for CoreWeave. Lastly, let's take a look at Zoom because Wedbush raised its price target on the video platform to $110, up from $95. The analyst said, quote, it has increased confidence in the company's AI strategy across its large cohort of enterprises to expand its wallet share across that existing consumer base. Now, the average price target on the street is roughly $97. Keep it right here on Yahoo Finance because we'll be tracking all the latest market moves and top calls throughout the session.
Lululemon is under fire for selling leggings that customers complain are see-through. Yes, again, it's not the first time that Lulu has faced backlash for its clothing quality. And this time it comes as the apparel company's in transition, seeking a new CEO and facing activist investor pressure. Yahoo Finance's Jared Blickery spoke to Adrian Yee, Barclays consumer discretionary analyst, about how the retailer could get back on track.
Adrian, thank you for joining us here. How does Lulu right the ship? So as we said, the CEO is out at the end of January, but the founder, Chip Wilson, has said there's been a loss of cool, and this is the second time within a year that they've had these quality control issues.
Yeah, so this isn't even the first time that we've had kind of a product issue. Recall back in 2013, the company had to remove, a significant portion, a double-digit portion of its bottoms because of quality control issues. What I would say is, now what's happening is we're much further on as a company, as an organization, and really what's happening is there's almost a panic to get newness to the market. So they talked about infusing about 35% newness starting in the first quarter of this year and kind of rolling throughout the rest of the year. What that does is it doesn't give you a lot of time to test in the marketplace and get feedback. And so that's one of the risks that we see them facing this year.
Well, and apparel in general hasn't had the greatest start to the year. I'm talking about stocks, and you're in the consumer discretionary analyst group here. Talk to me about what it would take. Are these macro headwinds? Is it just cyclical? What does it take to get some of these stocks back on track?
I think a couple of things. These stocks hit kind of bottom, right? A near-term bottom in probably the October-November timeframe. I mean, this was the worst place to be from a consumer discretionary goods. If you look at the sector relative to all of the other sectors, it was a straight kind of like do not touch. And I think at the back end of last year, we realized that some of the tariff pressure was known. It was in the stocks, or at least it was in the models, right? To the extent that it was going to be a net neutral as we go into the full year, worse in the first half, better in the back half, we're going to get price increases. So I think really what you need to see here is that the demand as we go into the first quarter, that there is stimulus that is driven by the one big beautiful bill, as well as past Fed cuts, right, to stimulate the consumer and to drive them to continue to spend, notwithstanding the fact that basically your entire wallet's going to be inflationary, right?
Yeah, well, and not only that, we just had a winter storm pass, which is definitely lowering consumers or separating them from the ability to spend that money at stores. I want to shift gears a little bit, and we're going to talk about Nike. I just saw this header across. They're terminating 775 employees as it accelerates automation at U.S. distribution centers. And I don't know if you've read the report, but just talk to us more generally about the influence of automation and maybe AI kind of creeping in and reducing headcount and maybe increasing profitability.
Yeah, the first place that you're going to see it, I mean, there's a lot of talk about agentic search and how that was up 700% during kind of Black Friday. I mean, we're really starting to embrace the information, the data flow. I think what you're really going to see, retailers, generally speaking, historically have been sort of behind, right, in terms of investing in all of this technology, et cetera. The functional aspect of digital and data, that has kind of forced people to gather that data. So the good part about omnichannel and digital is you have that data there, which they otherwise may not have had if they were only doing brick and mortar. And so what I would say is the first place you're going to see it, and the easiest place that you're going to see it, is inventory management, store payroll hours, kind of managing those hours, and through the supply chain, as you're mentioning right here. So I do think that the first place is cost reduction, and then the second place, which takes a little bit more personalization, finding out about that customer, doing a personalized search and customizing their CRM systems, that will really drive the demand side of it. But I think you're first going to see it most easily deployed sort of on the cost side of things.
I appreciate that. And as we head into earnings season in a few weeks, we're going to really get the retail crowd and a peek into what's been happening over the holiday quarters, and also more importantly, a look ahead into the rest of 2026. What do you expect? What are some of the tailwinds, headwinds, et cetera?
Yeah, the tailwinds are freight is your friend, right? So oil's been coming down. So that's a new tailwind that we have kind of this year over last year. If you're an apparel manufacturer, cotton's your friend. We've seen kind of, slight, benefit in the third and fourth quarters coming from those who do a lot of denim, like a Gap. And then I would say the other tailwind is going to be as we anniversary the back half of this year, you're going to get the kind of stabilization of the pressure, right, of that tariff. Tariffs seem to be the discussion is sort of net to the things might be a tiny bit better. So that's also kind of, not worse. And then the last part of it that kind of is the overall is what happens to the consumer when we raise prices 2, 3, 4% starting this season. And that can be kind of offset by some of the stimulus that we expect to come to the consumer. So net, we're looking at a flat to expanding margin year in 2026. We're not entirely kind of negative on this space. And what I would say is we get incrementally more positive as we head into the back half of the year. So we have a risk on for consumer discretionary. And we definitely think that you need to have some of that in your portfolio in the instance that we do get a little rollback on some of that tariff pressure.
Ton of insights there. Really appreciate your stopping by here. Thank you, Adrienne.
Thanks so much.
Coming up, General Motors expecting a strong year ahead. What the path forward looks like for the automaker as it pulls back from EVs. Stay tuned. You're watching Market Catalyst. General Motors shares are trading at a record. That's after the company says it's expecting another year of strong financial performance. This comes as the automaker sees higher demand for SUVs and trucks and pulls back on its electric vehicle plans. Here's what the CFO told our Subramanian earlier.
If you think about where we've been for the last few years, we were tooling up and scaling up to produce 1 million EVs a year because that's what the government was requiring under the prior administration. So with the changing regulatory environment, we see a much slower path to EV adoption, but we do see a path. As far as demand goes, I think it gives us time to get the charging infrastructure up and ultimately get people more accepting of EVs.
Joining me now, Tom Narayan, RBC Capital Markets lead equity analyst for Global Autos. Tom, it's great to see you. I do want to dig into that EV question, but first of all, just taking a look at this quarter, the buyback, the dividend increase, it seems like investors got kind of most of what they wanted here.
Yeah, I would agree with that. I think into the quarter, there's been a lot of negativity on autos, a lot of geopolitical questions and tariffs, et cetera. And some worries about U.S. sales. Would it be down next year and all of this? And so I think these results, first of all, just on their own, they were great. Make no mistake. But even beyond that, I do think there was some surprise factor to the positive. It's probably showing why there's an outsized positive performance.
Yeah, it seems that way with that 9% increase. I mean, the shares were already running up into this report, right? We've already seen some increases there. So what does this reaction imply about now what future expectations are for GM?
Yeah, I guess I was talking about just the past couple of months, how the stock was trading. But I think it's a very positive picture. We've been talking about this now for a little while now. We're very constructive on the U.S. auto market. We don't think a car is a consumer discretionary purchase. Unemployment is at record lows. GM is also especially positioned because they have like 60-70% of large SUVs and pickups. We know that the strength of the U.S. economy right now is on the higher end, right? Not on the lower end. That actually benefits GM. They're doing this big buyback. There are a lot of things also that came out on the conference call, which I think are important. A lot of people are worried about memory chips, right? And GM said, you know what, like, at least for now, things are okay, right? They put it in their kind of commodities bucket, and it wasn't even the biggest element there. And then the other big story is EVs, which I'm sure you're about to ask me about.
I am about to ask you about that, Dom. I thought it was really interesting that Jacobson painted this as, well, the government was making us do it, as though there's no consumer demand. There is still some consumer demand for EVs. Do you think that GM has sort of right-sized or corrected the course for their EV strategy? Do you think they've done that properly?
I mean, I think they've really done a great job, honestly, in how they've structured their EV deployment. They were later, right, than, let's say, Ford, for example. They have plants that are flexible. That's really important, right? Because, you know, for example, at Orion, they just, instead of making electric pickup trucks or what have you, make more ICE pickup trucks. That is a huge luxury to be able to do. And then, you know, in Ramos, they're making the EV Equinox and Blazer, and they can just shift production to ICEs there. And so I think it's also a smart way they put together their EV strategy. They still believe in EVs, right? Longer term. You know, I've been saying this for a long time. We did a lot of work on this. I think one of the big reasons why there's an EV slowdown, sure, there's policy, but it's also like you can get really cheap used EVs right now. Why would you buy a new one, right? So there's a huge glut of, you know, leases from 3 years ago that are hitting the market, and you can get really cheap used EVs. I think that's a factor. There is EV demand. People do want these products. We'll get there, right? It's just right now, GM can very smartly shift production, you know, and lower its EV costs. That was a big driver of their guidance that they gave, is coming from lower EV losses, and their, you know, 2026 EBIT guidance is coming in way ahead of 2025, and it could go even higher if we get a USMCA resolution. So I think that's really what folks have really focused on.
And Tom, as you mentioned, you know, unemployment relatively low. Consumer confidence, though, isn't great right now. We know that the consumer spending that is happening because of the top income cohorts in the U.S. So what does all of that imply for vehicle purchases this year, and specifically new vehicle purchases this year? As you say, it ain't just EVs, right? You can buy used vehicles generally at a lower price.
Yeah, that's true. But it's interesting if you kind of take a step back, right, and you look at the pandemic, and you look at the years after the pandemic, and you look at things like age of fleet, scrap rates, like how many vehicles are scrapped each year, looking at the past 50 years, and you extrapolate that, right, from pre-pandemic to today, you actually come up with a deficit of cars that were never purchased of about 5 million cars. Each year in the US, they buy around 16 million. So there's just a huge amount of cars that were never bought because of the pandemic. And like I said before, this isn't like McDonald's or Chipotle or whatever, right? You have to drive to work. If you have a job in the USA and you have to drive, you have to buy a car. And the age of the vehicle does matter, right? And for GM, they're selling cars more on the kind of upper end of pricing overall. So I think they benefit from this kind of higher end consumer benefiting, and the fact that the car ultimately, I just don't think it's a consumer discretionary purchase.
I mean, I took New Jersey Transit to work today, and I wish I had driven a car, Tom, on another note, for those of us who are relying on transit these days. Would you say that GM is I know you have an outperform on a number of names, GM included. Would it be your top pick within the sector right now, or would you point elsewhere?
We really like GM, definitely, but our top pick is actually on the supplier side, especially suppliers levered to GM. One example is American Axle. This is a supplier. They are doing an M&A, a deal with a British company, and there's a lot of synergies there that I think folks don't really appreciate, and they're going to benefit from the volumes that are going to come out this year and all the stuff I've been talking about. So we really like the U.S. supplier space. But yeah, I mean, GM is definitely a story that's going to work out continually. And we do see a tariff resolution as a big catalyst, especially Mexico, that should help the U.S. suppliers and OEMs like GM.
Tom, great to see you. Appreciate it.
You got it.
Take care. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance coming up.
time for Yahoo Finance's Market Minute. Consumer confidence plunged to its lowest level in more than a decade this month. According to new data from the Conference Board, overall consumer confidence index fell by 9.7 points in January from December's reading. The latest numbers show confidence is below even the lowest readings during the COVID-19 pandemic. Meanwhile, aerospace and defense giant RTX plans to continue paying dividends to investors even after President Trump threatened to stop doing business with the defense contractor. The company CEO made the comments on its earnings call and were first response to Trump's recent criticisms of major defense contractors for underfunding weapons production. And UPS plans to cut as many as 30,000 jobs in its push to save costs. The company CFO says reductions to its operational workforce will be achieved likely through attrition and voluntary separation agreements with full-time drivers. It's all a part of an ongoing effort by the company to rein in costs and boost profitability. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks at the trading session.
Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Jared Blickery, your host, and with me is my co-host, Yahoo Finance senior reporter, Brooke DePalma, who's here to connect the dots and to be that bridge between Wall Street and Main Street. Today, we've got a guest who focuses on short-term time frames. That's day trading and swing trading. Our word of the day is VWAP. It's a way of seeing the tipping points in the market based on market prices over time and weighted by volume. Sounds complicated, but it's actually pretty simple, and it's incredibly useful for timing the market regardless of your time frame. And on today's Market Show and Tell, we are going to break down our guest's proprietary setup that he calls Faux Show Bro, short for fake out, shake out with a VWAP breakout. If you are a regular listener, you might know who our guest is by now. And this episode is brought to you by the number 51. That's the ratio of the price of gold to the price of silver. What that means for the bullion trade, as silver is now topping $91 per ounce. And today we are welcoming back, you guessed it, Kenny Glick, who is the owner and operator of HitTheBid.com, a room for active traders where he's better known as the Warlock. He's a stand-up comedian who's been studying the tape for decades. And Kenny, by my count, this is your 6th appearance here on Stocks in Translation. So welcome back. It's been a few months. A little bit has happened. Just tell us how you're seeing the new year.
Sure. Thanks for having me. But before we get started, we've been having this raging debate about VWAP. WAP. There's no O in VWAP. And we just had a whole segment about it.
But it's Judge Wapner.
I know.
It's not Judge Wapner.
It's a tomato thing, but I'm making a concerted effort.
To be fair, Brian
VWAP.
Shannon, who is like the king of VWAP,
Yes,
he says VWAP, and I know a lot of traders on the floor of the New York Stock Exchange. I just can't bring myself to do that.
My Italian friends are very upset. So.
All right. So how are you seeing
2026, how's it shaking out?
Right. So far, so good. Yeah. The activity is phenomenal. Earnings season just started and already having a ball. Short of JP Morgan yesterday. And it just, again, just to date this show right now, yesterday's action was super, super bearish. And I love it. The volatility products were peaking up and JP Morgan, there was nobody buying it. So I woke up today and I was like, listen, I know we've been talking about how the market never goes down. It's definitely going down today.
You are a big bear. Let me ask you. So,
Yeah.
Are you saying that is this a call on the general market? You think we're at a temporary top here?
Well, that's a good way to say it. Because you can never say the top is in. There is no top. There is no spoon. So, I'm not calling it, but right now I am liquid and loving it. And again, I don't sell the Qs because that's the family investment, but.
Yeah.
I am so liquid right now, and I'm loving it. So again,
Gotcha.
JP Morgan today, Citibank, JP Morgan yesterday, Citibank today, just crushing the banks, and finally the Qs gave way. So if you haven't noticed, the Qs kind of still haven't broke all-time highs.
No, they haven't.
The
Dow
market's
has
been-
S&P, Russell, but not the Qs.
Right. So something's going on right there.
All right, well, I'm going to try to say it as best as I can, but let's get to our phrase of the day. And that is, well, you guessed it, VWAP. VWAP is one of those trading terms you hear a lot. You've already heard it about 10 times in this episode. But most people don't realize it's basically a fair price snapshot that tells you where the real buying and selling happened. It's an average market price that's weighted by volume. So those high volume trades count for more. It's like volume backups for the argument for a price. And Kenny, we know VWAP is not just an indicator, it's a way of life for you.
Yes,
But
see the
on the
t-shirt.
chart, on the chart, you trust when everyone else is arguing about the story. Tell us exactly how you use this.
Well, first of all, again, I like your description. It's kind of like institutional order flow. And, you know, again, as successful as some of us might be, we're still insignificant fleas, the day trader, right? We're looking for that institutional move. So what we're looking at, you know, specifically with the JP Morgan yesterday, as it's gapped up and everyone's looking at those earnings, we're just looking at VWAP. And when it breaks through the VWAP, and what I look at, speaking of Brian Shannon, multiple time frame, if you break today's and you break the prior day VWAP, almost 90% of the time, you're going to start a trend that is that direction for the day. It doesn't matter what happens tomorrow because we're day traders. But if you can make yourself 7 or 8 points with very limited risk, every trade you put on around VWAP is limited risk. You know exactly where you're getting in, you know what your risk is, and then you basically just milk that trade throughout the day. And yesterday was fantastic.
Jenny, I got FOMO right now. I want to become. I want to
We
be
wanna
a
jump
day,
in with you. It
I
sounds
want to be a
exciting.
day trader again and join your room. I want to clear up a couple things about VWAP here. I'm going to keep calling it VWAP. I
It's
know
all
that
right.
gets you. So when we say that, we're typically talking about, because this is a history, what the VWAP is on the current day. So you take the beginning of the day and it's the average price throughout the day, weighted by volume, et cetera, et cetera. And when you talk about the prior day's VWAP, wherever it ended, that was the ending point for that day. But we also have something, Brian Shannon again, called anchored VWAP.
Correct.
And it's actually very similar to something that emerged in the 90s called the Midas market of analysis. And that's kind of archaic here. But in anchored VWAP, you're taking a different, it could be like the beginning of the year, it could be an important bottom, it could be an important top, but you're doing that over time. So where it's not intraday, it could be on any time frame. And
Right.
that's what we're talking about, the versatility of VWAP here. So
Right.
you use anchored VWAP in other time frames?
Well, I anchor it to something very, very specific. So right now we just got into earnings. So I want to know what the VWAP
That's a
was
great use.
over the last 3 months. So
Right.
I'll just take the data from last JP Morgan's report, put it on my chart. So I'm looking at today's VWAP, the prior day, and let's call it the 3-month VWAP. And again, it really just gives you a beautiful snapshot of that institutional order flow since the last earnings report.
Yeah.
So when price discovery starts to happen, and again, what is really nice is when, again, I call it the rigging of the market. And when stocks retrace and people think it's some random sell-off, and then you come back to a 1-month VWAP, and sometimes you hit it to the penny. That's what's amazing about it. And that's why, you know, I've been using it now exclusively since 2012. I'm thrilled every day. I mean, it is still fascinating. And again, you know, talking about the markets, this is by far still, since COVID, day trading is back in a big way. There is so much more volume, there's so much more activity and so much more opportunity. And if you just stay focused on VWAP, it really just helps you stay disciplined. But back to the anchored VWAP, yes, he anchors it to very specific moments. I anchor it to specific days because through experimentation, I found that most stocks will live today's VWAP, prior day, and a good 5 days worth of data. But then earnings season, I'll look at that 3-month.
We talk a lot and we're joking a lot about how, wow, we want to jump right in with you. And I'm sure some of our listeners out there are like, wow, I really want to jump in on this too. Obviously comes with a bit of risk here. So what's your message to potential new day traders, things of that nature? They're looking to understand this. Probably
Start small, like what
start
is it?
small. Yeah.
Absolutely. Well, if you're just getting started, I always tell people, don't quit your real job. Okay. And just learn, experience it. And that's what we do. You know, again, that's why I pride myself on doing free ceremonies, free trials.
like
It's
it.
turning
Yeah, it's a
into
sermon. It's a
monumental.
sermon. I'm going to Vegas next month. It's going to be a sermon of VWAP. It's going to be hilarious. I can't wait. I think I might just wear a white suit when I do it. But just if you're getting started, just watch it. Just behold what it does and how the stocks will ebb and flow around multiple time frame VWAP and today's VWAP. And you'll start to say, oh, okay. So, you know, again, let's talk about my nephew, still in high school. And I started showing some charts. He was trying to learn how to trade. He was getting into crypto. I was like, leave that crypto alone. Let me show you real stocks. And the first thing I showed him was stocks will retrace to the VWAP intraday. So he says, Unc, so if it holds the VWAP and starts to rally off it, I should buy it off that rally and use VWAP as my stop. Yes. Now you don't have to go to college.
All right, we got another setup here because this is key for our market show and tell. And this comes straight out of Kenny's personal playbook. I mentioned it before. It's called Faux Show Bro. Kenny's shorthand for fake out, shake out, breakout. And the breakout can be based on VWAP. So here's the idea. You get a dip that flushes people out. It feels ugly. It feels like the move is over. And then price snaps back. It reclaims that VWAP line and it breaks above it. That is the momentum entry that Kenny is watching for. So Kenny, when you do see this Faux Show Bro setup, is this, how do you manage it? And how often do you see this? That's what I'm really interested in. How often do you see these patterns?
Oh my God, this is what's so amazing about it. We've been using this since the 90s. So now that I've overlaid VWAP with it, so basically the Faux Show Bro is it's a fake out, it's a shakeout. So you're getting a second leg down, which as a shorter, that used to convince us, hey, this thing's going lower. And then it makes that U-turn. And the shorter, we're always living in denial because we're delusional psychopaths. We think, oh, everything's going to zero. But then it makes that turn. And one of the things, when I say VWAP saved my career, it saved my life. Because as a shorter, I just didn't want to give up on those trades. So if you get the fake them out, shake them out, and then you're breaking back over the VWAP, most of the time that trend is changing. So what also is talking about new traders, that the faux and the show are your stops if the VWAP break doesn't happen. So if you don't get that breakout movement, the fake them out, shake them out area is where you're going to use your stops. And again, to reiterate, the reason this trade works so well is that the longs are getting stopped out and the shorters get encouraged to take that short position, and then it turns around. Everybody's wrong. The fear of missing out kicks in. The long trader wants back in, and the short that knows what he's doing, again, the shorter who knows what they're doing must cover and go long. So a lot of times you're actually a victim to that trade because it does feel like you're going lower, but the skilled trader who can accept loss, and again, that's part of it. Sorry, internet. People lose money trading. You have to accept that loss, and then you see that pattern, you join the winning team, and then you make all that money back.
At what point do you understand, okay, I need to step out of this? It's come time.
The VWAP break, right? So the VWAP is the confirmation of the fake them out, shake them out. So sometimes you'll get fake them out, shake them out, and you hit the VWAP, and that's it. And you roll back over. The shorter still has that, that chance to make money.
Get a few tears.
Do you ever get a false breakout to the upside? Because how do you define your risk then? Do you just place your stop below VWAP then? So in other words, if you got the Faux Show Bro signal and it comes back down, so it's like a fake out on top of a fake out, how does that work for you?
It's a great question, because sometimes you'll get the faux show underneath the VWAP, and then when you get to the VWAP, it starts to make that new pattern. So sometimes you'll get, we call it the VWAP shuffle. You're shuffling along, you're jiggling along. The market's trying to make you lose money. It really is.
That is the goal of market.
Yes, it's trying to shake you off the bat. It's trying to get you off. It's like a bucking bronco. So I love when that trade happens. But because we're using those lower areas as the stop, we're not really getting too chopped up in that jiggle, and we're waiting for that moment to finally make that move. But if you see a little tiny attempt, mini Faux Show Bro right around VWAP, that actually confirms that you're going to be right about this trade. And again, a lot of times you will get jiggled out, as we call it, or shuffled out. You just got to say, okay, I just got shuffled. Let me get back in and, make that move.
I'm sure we'll hear VWAP at least 10 more times during this episode, but we do need to take a short break. But coming up, we're talking silver and gold, and we've got a runway battle featuring some legendary comedians. Stay tuned. This episode is brought to you by the number 51. That's the gold to silver ratio, which means that gold is now 51 times more expensive than silver. It's a simple way that traders use to compare how silver is moving versus gold. This number was over 100 recently, and now it's half that, and it's at the lowest level in more than a decade. So this is telling us that silver is rapidly catching up to the price of gold. Kenny, what can you tell us when you think about silver, when you think about what we've seen lately? I know that you even have silver coins.
We just
What do
want
you
to see
make
the
of all
silver in your
this?
pockets.
Okay. I
we
mean, I'm
go.
always jiggling, baby. But if you put a bull and a bear on a silver coin, I'm in. So I've been carrying these as good luck forever. Just long story short, I was a baseball card guy, and that's how I got into the market, speculating on players and basically selling into strength. Jose Canseco, Mark McGuire, just to date myself.
Yes.
Big 70s guy, George Brett Robinson. And those baseball card shows, there was always silver and gold guys there. And I didn't have money for the gold, so I flocked to the silver. I did trade a Johnny Bench rookie card for an ounce of gold. Still have it, actually the same one. But the silver trade to me, this is a 30-year. We've been waiting for 30 years for this. And
the longer the base, the higher in space, as they say. So how high does this go, Kenny?
Well, right now, 50 got us 80, which was what I've been telling everybody. If we can just stabilize over 50, we're going to get 80. Didn't think it was going to happen this quickly. That's what frightens everybody.
Yeah.
But
Do you think it's happened too quickly?
a little bit, yeah. It caught a lot of us off guard because, even the stackers, I buy every month. I buy bullion, I buy coins. And, again, I was buying at 30 and 40 just every month, and then next thing you know, I'm paying 60, 70 for the same stuff I bought a couple of weeks ago. You don't want to keep putting the same amount of money in. Plus, you're not getting as much.
Yeah.
But my God, it is the coin shows were packed. There was a line to get in. I've never seen a line to get into one of these shows.
I have not heard of that.
Me
Yeah.
neither.
Everybody, and that's a frightening thing when it's the crowded trade.
Yes.
But also on the flip side, when people see this monster parabolic move, the shorters get involved.
Mhm.
And again,
And then they're the fuel.
yeah,
Oh, show.
yes, yes, and the shorters are generally they're wrong. Okay, because they see this move just like in the markets, right? Just because something's gone up parabolically doesn't mean it has to come crashing back down. It can consolidate, just like that whole overbought thing.
Yeah.
If something's overbought, sure, but if it stays overbought for a given amount of time, it's no longer
Correction in
the
time.
overboughtness it kind of dissipates. Same thing I think is going to happen here. So if we could stabilize between 70 and 80, that would be lovely. Because if we do, I think we're off to 120, and then we could get real parabolic. I don't want to go nuts here, but 120 gets us 180, 180 gets us 250. And if we're looking at 250 on
Are we
silver,
talking about
parties
I
at my
need to-
house.
I think I
Parity
need to
with
go to a
gold?
gold show soon.
Parties at my house, silver at 250.
All right, Kenny, I want to, on previous episodes here where you've joined us, we've talked about the robot, you've talked about the robot, space, quantum, and maybe a couple other things in there.
Right.
Are you still trading those names, or are they just not as exciting because you got other things?
Oh no, I love them. Space rockets, robots, quantum AI chips, and of course the drones. Shout out to Rex Shares. They put out a DRNZ, fantastic little ETF. So big fan of the drones. I'm hoping it's not a fad, but I do own the index. That's the way I invest instead of picking individuals. But right now, that's where the money's going. And the rare earths, they had their moment. They came crashing back down. Still trade them. Again, as a day trader, we just go where the action is, and that's why VWAP means so much to me. VWAP is showing you where the action is.
You literally said VWAP saved my life. I'm going to get that on a shirt for you.
Yeah, it really did, especially as a shorter.
Yes, sir. All right. Any other market stuff we haven't covered? Specific techniques. We talked about Fosho Bro, VWAP. What about risk management? I know you talk about using VWAP as a level, but how do you think about it? How do you approach it? And this is very important for new traders.
Well, like I said, it's mostly a day trading tool for me, and I'm mostly a day trader. But looking at it,
But like, do you set your stop as soon as you go in? Like, how rigorous are you
How are
about
you
your
starting
plan?
the day?
Oh, great question. And again, I'm very pessimistic. Again, it's, I guess, a Jewish mom. She's instilled this into me. Nothing's ever going to go right, but I should be happy when something does. So when I get into a trade, just like the JP Morgan yesterday, I'm shorting at VWAP. The prior highs are my outs. And again, my preparation is who reported earnings and what companies. There's always some therapeutics stock every day where the volume is. You probably go by, I'll probably trade it, CRML, where the volume is that day. It gives us the advantage because that's when VWAP works its best. Small cap stocks with 40,000 shares trading on them, they're still going to be in the hands of the manipulators. And again, that's why I love VWAP also. You are now you're not being manipulated. You are the manipulator.
You're reading the footprints.
Yes,
Reading the
yes.
footprints.
So more volume, it's actually safer. But generally my standard practice, I wake up in the morning, I'm looking at earnings, who reported last night, who reported in the morning, and then I look at the high volume, the percentage gainers. That's where you usually find those therapeutics, those biotech stocks, and those are a lot of fun to trade because you get those $2 stocks that sometimes that rip to $20-$30 or even more. So
My gosh,
Or
I
they
can
go
feel
to
the
zero.
energy. I'm moving, it's like
eventually they
smoking.
do. Yes.
But what I will say is we've been talking a lot about the show about the optimism around AI, but also around space in general, potentially getting a SpaceX IPO this year.
Yes.
How are you thinking about that trade and maybe not necessarily SpaceX, but the others that are
Yeah,
surrounding?
and IPOs in general. Do you trade IPOs?
Well,
New listings.
I don't have good luck with them, but they're that MDLN. Again, the volume that came in on the buy side on MDLN, you could not resist buying that stock, and it was just phenomenal. The other IPO that I did well on was Viking, the cruise ships.
Mhm.
Nobody talks about it, but the volume that came in on the buy side was extraordinary. But generally, the way I look at IPOs, it's the company's way of cashing out. So
Yeah, it's a liquidity event for the insiders and the people who bought early.
right.
And now these companies stay, private for 10, 20 years. So you're kind of a bag holder sometimes.
Precisely. So what I like to wait for is if the IPO breaks IPO day. I like when the opening tick is the high of the day
Mhm.
because then I know where I'm going to buy. I had a good success with ARM, good success with ALAB. They kind of went down first, consolidated, and when they break, and again, you get the big faux show, bro. It works on, works on every time frame. If you get a big shakeout, kind of like NAVN, terrible IPO, opened up below the IPO price. They crushed this thing 50%, but on earnings, you had an intraday faux show, bro, and you had the long-term chart where it broke a new low, came back, and then started breaking out. And that's when we
Oh,
started
show,
looking
bro,
to
on
buy.
multiple time frames. We got to do that. That's a topic
Yes.
for another show.
Yes.
All right, we only got a few minutes, so we got to get to our markets take on a classic Hollywood gab show staple. Who wore it better? Today, we've got two legendary comedians squaring off, repping two different types of market energy. On the left catwalk, we got Bill Murray. He's rocking a calm conviction. He's in an understated blazer, vintage sneakers, hands in his pockets, totally unbothered. He's got that wait for the moment vibe. Let the price come to you. Don't force it. And on the right, we got Kevin Hart. He has pure high octane participation, bright bomber jacket, statement sneakers, mic in hand, ready to hit the gas. He's the energy when the tape gets loud and everybody leans in. So Kenny, who's wearing the 2026 tape better? Is it Bill Murray's patience or Kevin Hart's full speed confidence?
I don't even have to see the picture. It's Bill Murray.
Mm.
Not a fan of Kevin Hart, but Bill Murray, hero of mine. Yeah, I met him when I used to work at Saturday Night Live back in the day.
He's done spots for
Ah.
Yahoo as well.
Yes, lovely gentleman. He's a lot of fun to be around. So anything Bill Murray does, I'm in.
I almost forgot that you work for Saturday Night Live very briefly.
Very
What-
briefly.
Random side little fun fact
Yeah,
you're
can
just
you
throwing
just
out there,
break that
Kenny.
down for us one more time?
Well, it was a sad moment, but I was just an intern. I used to work Thursday nights, Friday nights, and which was awesome. Friday nights was amazing because I got to watch
Yeah.
kind of like the run through.
Mhm.
That back in the day when Phil Hartman was there, and there was a place called Broadway Video. I still think they use it where they would do voiceovers. So I actually got to walk over with Phil Hartman to do the voiceover. So we were on the film. I was on the film unit.
Mhm.
Those fake commercials that they would run right before
Right.
the show. They don't do too much of those anymore. But also, I was just a lowly intern answering the phones. And one day I answered the phone, apparently with a funny voice. And the guy on the other line didn't like my voice.
Oh.
And I was asked to leave. I needed to leave the building. The guy said, "Hey, is that how you answer the phone?" And I probably did answer with some flair, Saturday Night Live, and he was mad. I think that I didn't know who he was because he was the film unit director. I don't want to say his name
wow.
right now, but it was a fun month and a half. I think about 2 months. I got to meet, Rob Schneider, Adam Sandler was there, just getting
Amazing.
started.
From there, though, all the way to day trader, I mean, journey speaks for
Oh
itself.
my
Oh,
God! Yeah.
I see the synergies. So they're like this.
You're right. Well, that's why, again, that's why I do a live show every day. I try to make it fun. And
I
I
hit the bid.
have a captive audience, so they
Yeah.
have to laugh at my jokes or I kick them out. So, a lot of stories. Yeah, I was in a record
me a
industry
few
for a while
ideas
too.
for-
So long life, but I'm having a lot of fun now. Yeah,
Wow.
suffice it to say.
All right, Kenny, I can't wait for appearance number 7 here. And just to review, we talked about VWAP one more time with Kenny because, well, we can't get enough of it. And VWAP literally saved his life. So it's just that kind of finding the equilibrium between the buyers and the sellers. When the market price is above it, you know that the crowd is bullish and the crowd is making money. And when it's below, they're losing money. So you can use that accordingly. Also talked about the faux show, bro. I can't repeat that enough. I look forward to breaking this down on our
Thank you
live
so
shows.
much for bringing it. I mean,
Yeah.
we've been saying it for 30 years. I'm so
It is
glad.
now canonized. If you search for it on the internet, I hope it shows up. We're going to put that in the comments or
I'm
something.
so excited.
And it's really nearing the time when we got to wind things down here at Stocks in Translation. So be sure that you check out all our other episodes of the video podcast on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms. So be sure to leave a comment, subscribe wherever you get your podcasts. And we'll see you next time on Stocks in Translation.
Welcome to Trader Talk, where we dish out the latest Wall Street buzz to keep your portfolio sizzling. I'm Kenny Polcari, and I'm coming to you live from the Yahoo Finance Studios here in the heart of New York City, a global hub where deals are made, fortunes are built, and the next market move is always just around the corner. Coming up, I'm going to share my thoughts on investor curiosity and education. We're going to chat with my good friend Caleb Silver and share my bay scallops and a black truffle cream sauce. Oh my God, they're so good. Now, let's just jump into the big take. The moment you think you've got it all figured out is the moment the market humbles you. It's not an insult, it's a fact. Markets evolve, technology shifts, policy changes, and new risks appear out of nowhere. If you stop learning, you don't stay still, you fall behind. Curiosity is one of the most underappreciated edges an investor can have. The best investors are not the loudest or the most confident. They're the ones that are constantly asking questions. Why is this stock moving? What has changed? What am I missing? They read, they listen, they study history, and they challenge their own assumptions. They know yesterday's playbook won't always work for tomorrow. Now, look at how quickly things change. A decade ago, no one was talking about AI as the driver of earnings. 20 years ago, few imagined smartphones would reshape the global economy. Go back even further, and entire industries that once dominated have now vanished. Investors who stayed curious adapted. Those who clung to old narratives, well, they got left behind. Learning isn't just about chasing new ideas, it's also about unlearning bad ones. Knowing when a thesis no longer works is just as important as finding a new one. Curiosity keeps you flexible, it keeps you humble, and it keeps you open to opportunity when others are stuck defending outdated beliefs. Bottom line, the market doesn't reward confidence, it rewards preparation. The investors who win over time are the ones who never stop learning, never stop asking why, and never assume that they've arrived. Stay curious. It's the one edge that compounds forever. My next guest is Caleb Silver, Chief Business Editor of People Inc. and Editor-in-Chief of Investopedia, one of the most trusted financial education platforms in the world. And I should say, he's a very good friend of mine. I've known him for years. Caleb helps millions of investors make sense of markets, money, and the economy by translating complex financial concepts into clear, actionable insights. With a deep background in financial journalism and market analysis, he's at the center of how retail investors understand everything from stocks and crypto to inflation, rates, and personal finance. It's great to have him with us. Ladies and gentlemen, please welcome Caleb to the show. Caleb, it is a pleasure to have you. Nice to see you. Happy holidays, all that good stuff. Happy New Year. It's all very exciting for you because there's lots going on.
That's right. Thanks. So good to be here with you, my friend.
Well,
we usually are talking over Zoom, and I'm asking you for recipes, but to be with you in person on your show is
It's
an
so
honor.
great to be in person because it's a whole different energy when you're talking to someone face to face. So let's talk a little bit first about this exciting news that you have, because you've gone from, you're still editor-in-chief at Investopedia, but now you've got a whole new line in your title. Just tell the audience a little bit what it's about.
Yeah, I'm the chief business editor now for People Inc. People Inc. is the parent company of great brands like People Magazine, People.com, Food and Wine, InStyle, Travel and Leisure, Real Simple, Southern Living, Midwest Living. I got about 40 brands.
I love that whole idea.
Yeah, and they are our parent company. They've owned Investopedia for about 6 or 7 years.
Right.
And so just recently, I've sort of now covering the entire portfolio, which I was doing a little bit, but now it's official. So now I'm doing the business of travel, the business of great food and wine, something you and I are passionate about.
Yep.
In addition to being the editor-in-chief of Investopedia, we are 26 years old, Investopedia, and I've been with the company now 10 years. So it's been the honor of my life to be the editor-in-chief. I still have it. It's still my number one brand there, but now I'm representing the whole People portfolio.
Investopedia, I have to say, Investopedia, like Wikipedia, is a great resource, right? Because there's so much information in Investopedia, and questions answered. People can go in there, they can type a question, they're going to come up with an answer that's easy to understand, it's actionable, and it doesn't make people feel like they don't know what they're doing, right? It's an easy way to understand some complex kind of ideas, right?
And that's what we're known for. We started out as sort of a financial dictionary or encyclopedia, but we are, the difference between us and a Wikipedia is we are written by experts, reviewed by experts.
Right. You kind of morphed into this large educational platform, which I think is great.
Yeah, and that was a good move by us years ago by the founders and the companies that have stewarded it since. We've been a part of the, as I said, the People family for about 7 or 8 years now, but just focusing on education, making sure people understand investing, money writ large, finance, how to make decisions that'll impact your life without being political, without having a bias, just giving people the facts turned out to be a pretty good idea.
Right. Well, because investing shouldn't be political. It should not be. While you can understand and take policy into your investment thesis, it shouldn't be political.
Right.
Right. Certainly Democrats might have a different policy view than Republicans, but therefore, as long as you understand it, then you can invest. That's kind of what the important thing is,
Absolutely.
right?
And as you know, as a great market historian, really doesn't matter who's in
It-
the White House.
Correct.
Market's going to average 10 to 12% a year on average for the past 50 or so years.
Right.
Could change at some point in time with policy, but in general, investors, they've learned to understand that that doesn't matter as much. We just need to know the information so we can make the best
Right.
decision.
And for most people, as long as you build a well-balanced, diversified portfolio, it can ride almost any storm. It's when you get out of whack, right? When you get way overweight in one sector or way overweight in another sector or underweight in a sector is kind of when you're out of whack. So I think it's very important. I love what you're doing at Investopedia. I love the whole platform. I think it's great.
Yeah, when you've been a good a part of it and been on my show many times, and just learning from you has really influenced me in my career. So I
Well,
appreciate
thank you. I appreciate that. I appreciate that. So listen, let's talk about a couple of things because there's actually a lot to talk about. But one of the things that I like about what you guys do is that you're really in touch with the retail investor, with sentiment, with how what the retail community is kind of thinking about, asking the questions they ask. So tell us kind of recently, what are top of mind things for retail investors that come to the Investopedia site?
Yeah, so we have about 8 to 10 million readers in a month in the U.S. who are just coming through our site to try to learn something.
8 to 10 million
Yeah.
a month.
Just here in the U.S., and that gives you a lot of data. We have our fingers on the pulse because we know what questions they ask. Not only that, Kenny, we know the journey they take through our content. So they may start with a question about tariffs, but what they really want to know is what's the impact of inflation going to be on my portfolio?
Right.
So we look at the top terms that people are searching for on a daily basis, or what articles are gaining a lot of traction with our readers. And then we look at it on a monthly, quarterly, and then an annual basis to come up with our terms of the year. So this year, 2025, affordability has been the number one term.
Right.
And I think it's not just affordability about the cost of everyday items, because we know those are getting more expensive, except for gasoline. It's about affordability and priciness in general. The stock market, is that affordable anymore?
Right.
Can I afford to invest?
So this question, we'll talk about that. Affordability, though, was that a term that most recently came to the top of the list, or has it been something there all year?
No, it's been bubbling up all year in various aspects.
Right.
And it is typically not a term people search for. Typically, they're searching for a root cause. So that could be tariffs, which was our term of the year last year. Number 2 this year, but this year was about the cost of living.
Right.
The cost of everything. How much does it cost to be me? And why do these things keep going up in price? I think healthcare and the concern about healthcare premiums rising in 2026.
Right.
And the shutdown had a lot to do with that.
Right. Well, because it's become the word, the newest term, right? Everybody's talking affordability now. And so it makes sense that the retail investor is going to start searching for that word to understand, what it means to them. What's it mean to the market? What's it mean to maybe a range of things, including healthcare, including, food, products, tariffs, groceries, whatever, which I think is interesting. What other terms are kind of top of mind for investors?
Yeah, well, this year they were also looking up tariffs, as I mentioned, but gold was huge this year because it's been the best performing asset
2 years in a
of the
row.
year. 2 years in a row. And you know how rare that is. No matter how rare the metal is, that's very rare. So people were looking at that. And you could tell that was one end of the barbell. Kind of the other end was AI stocks, right? And some crypto, but mostly AI stocks. And I think that was, that we've seen a lot of volatility in them, especially over the past few months, but also some people feeling like they missed the boat, even though they probably didn't, because they own an index fund, which means they own AI stocks. And then the more risk-averse crowd wanting to own gold, wondering if gold's going to continue to go up. How can I buy gold besides going to Costco and getting my little ingot there? Can I buy a GLD? Can I buy a proxy for it?
It's interesting. You bring up a point about when people say, is it too late? Did I miss the boat? Are things too expensive? Think about this. There is always new investors coming into the market. Someone that's just starting out, they got out of college, they got a job, now they got money, they want to put it to work. So they're 24 years old. Can you say to them, it's too late? No, of course not. You would never say to them. You say you have to jump in, right? So you have to start. You start slowly. You start broadly. Maybe it's an ETF until you build, right? But it's never, in my mind, it is never too late to jump in.
Absolutely not. We get this question a lot at Investopedia. How should I invest $10,000 right now?
Right.
Well, the answer for you is different for me. It's different for a 21-year-old.
That's right.
It's different for a 75-year-old. So it depends on who you are, and we're trying to help people using technology to give them the best answer. But the fact that we're getting that question a lot means there's a lot of new investors always coming into the market.
New investors that are curious, that maybe don't understand it. They don't know, or maybe they think it's gone too far. Because, we hear in the news, we're in an AI bubble. So people are now afraid to put money to work in AI stocks. I think that's a huge misnomer because I don't think we're in a bubble at all. But we're gonna take a break. We're gonna come right back. We're gonna talk about that. All right, so let's come back to the AI bubble because that seems to be top of mind for everyone. Because I'm in the camp that we're not in a bubble. Stretch, maybe a bubble, absolutely not. What do you?
Yeah, I'm in the camp that it may be, but I don't think it's the type of thing that's going to explode all at once. There's pockets of this spend and pockets of excess all over the place. We ask our readers in our sentiment survey, we just fielded it, the last one of the year. Are you concerned about any of these assets being in a bubble? AI stocks, top of the list, of course. Guess what? Those are also the top stocks they own in their portfolio.
right.
So it's self-reflective.
Yeah, I hear you. And I wonder, though, if a lot of people are saying that because they're hearing it in the media that we're in this bubble, which I think is also a negative because I'm in the camp that I think we're at the beginning of this AI tech revolution. I don't think we're anywhere near it, near the middle of the end at all. I actually think we're still in the batting cage. I don't think the game has started yet. We're still in the batting cage, right? But I think it's interesting because they hear the word, they hear the conversation, and so retail investors that aren't in this business every day, they get nervous. What should I do? Maybe I'm not going to put money in the AI trade, which I think is a huge mistake because AI is going to be the future.
Yeah, I agree with you there, and I think people hear it and guilty as charged. The media is always talking about it. Put on any business news channel, and you're going to be like, a lower third that says AI bubble, overvalued. So it just bubbles up the more you hear it. But people were also looking and didn't make the top 10, made the top 20 at the internet bubble and the internet stock mania of the late 90s,
Right.
wondering if this was very similar.
Right. And so what do you think? Do you think I don't think it's similar at all, but that's
I don't think it's similar at all. But
Right.
if you go back 3 years and you look at the release of Chat GPT commercially, which you
Right.
go all the way back to 1996, 97, and you see Netscape's release of Mosaic, the NASDAQ looks very similar in terms of those timetables and the amount that it gained. But this is real money being
But-
spent, not pets.com.
exactly. And they're also companies that have real products and they get real revenues and they've got real growth paths. Pets.com and the rest of them had none of that. They had no income, they had no revenue, they had no history.
Pre-revenue, pre-profit.
Right. And so I always say to people when they ask me, because I'll have investors say to me, it's too late. It's not too late at all. Now, if you're just starting out, it doesn't mean you take everything you got and put it in one day. You would never do that. You have to feather it in over time and take advantage of market moves. That's what I would say to anybody who's coming into the market. So it's a question like when someone says, what would you do with $10,000 today? Okay, is that all you got? Are you going to put more? How much time do you have? There's a lot of questions to ask, right? What they need it for, what they're hoping for it to be, how often are they
Can you
gonna-
afford to lose it?
That's right. Well, I guess that's the real question. Listen, I want to talk to you about crypto and tokenization because I think those are two other words that must be on your list somehow. Because I think crypto is one thing. People think of crypto, they think of Bitcoin, but tokenization. Talk to me about tokenization and maybe what retail investors think it means or what Investopedia thinks it means.
Yeah, well, this I think is going to be one of the most important themes in 2026.
100%.
The tokenization of assets, including stocks, which means it'll be digital representatives, kind of like an NFT of a stock that will trade on an exchange like the Texas Stock Exchange 24 hours a day, 6 days a week. Ken.
Right. And you'll be able to buy pieces of it.
Right.
Instead of
Pieces
buying a
of it.
whole share, you're going to be able to buy a piece of it.
In a 24/6 market, anything can
Anything
happen.
could
And that's the thing about crypto that brings these together. The crypto market trades 24/7. So tokenization is not cryptocurrency, but it is similar in that it is a digital representation of an asset.
Right.
And in crypto, there is no asset necessarily, except the greater fool theory of what people think it's going to be worth.
Right.
So we're entering a really weird space, along with predictive markets and sports betting and options trading, and day trading, slamming together at lightning speed. This is going to be the mess we will see in 2026, and we'll see if it blows out the capital markets or if it brings more people into them, and that drives markets higher.
You can bet on almost anything. Someone's willing to make you odds on almost anything, anywhere, which I think is kind of interesting. Even the odds on who the next Fed chair is going to be, or the odds on where rates are going to go. I mean, they bet on everything, which is interesting. But I think a lot of that can be also noise, and it can create angst for people.
It can, but the predictive markets were actually more accurate than the polls.
Yeah, no,
during the
100%.
election season.
Yes, they were.
And they're getting a lot closer just because you have a lot more participants, which means more data.
More
Wisdom
data.
of crowds can help you get to tighter answers. So if that becomes the leading sort of indicator of which way markets and individual securities are going to trade, that's going to take us into a very strange place because it could be potentially manipulated.
So pollsters are probably going to be out of a job pretty soon.
Yeah, right. Who needs to know that? But take this a step further, Kenny. You got ICE, the owner of the New York Stock Exchange, making a $2 billion investment into Polymarkets because they know that predictive markets people want this as a part of their mix. One of our top terms in 2025 was parlay, which is a sports betting term when you bet multiple legs of a bet and all of them have to pay out in order for you to win. You want, the Chargers to win, and you want 10 rebounds by this guy, and whatever. You put together a series of bets. They all have to pay out. They all have to win for you to win. Take that to stocks for a second, Kenny. If you're betting on the outcome of 3 different stocks or a different directional move for 3 different securities at the same time, as a trader, not a long-term investor, that could disrupt pricing.
100% it could disrupt pricing. Look, I think a lot of things disrupt pricing. I think you look at triple levered ETFs can disrup pricing. And now they're talking about 5 times levered ETFs as if we need that risk in the market. I don't think we do. See, I'm on the side that I think they've created this casino-like atmosphere, which I think is the wrong thing to do. But to your point, it is what they wanted, so it's not what they got, but it creates this potential volatility for the guy who just wants to be a long-term investor.
Yeah.
Right.
That's to me, that is one of the biggest questions for the next decade.
Yeah.
How does all of this affect long-term investors and this diversified all-weather portfolio strategy, doing
Right.
the right thing, not trying to time the market, just being steady as a long-term index investor or ETF investor.
Yeah.
That's going to get weird.
It is going to get weird, and actually, it's going to be interesting to see how this plays out because um, it will create lots. It has the potential to create lots of volatility, and not necessarily good volatility, right?
Right.
Let's talk about behavioral mistakes that you see maybe in the Investopedia portfolio in terms of either the questions asked, but what do you think of some of the biggest errors that retail investors keep making and making and making? Like they're not learning from it.
Yeah, timing, right?
Timing.
Trying to time the market. We know
Yeah.
timing the market's always better than that, but timing is now the right time.
Yeah.
Taking or not taking profits when they should, not having a rules-based approach
rules-based
to
approach,
investing, right?
right.
So I've had hundreds of people come to me personally and also thousands coming to our site saying, should I take profits in X stock?
Right.
Not X, NVIDIA.
Right,
for
right,
example,
right.
Or any of the big stocks that have made major moves. And the question I always ask them is, what are your rules?
Right.
Right. Do you have a rule where if it goes down 20%, you get out? Do you have a rule that if it goes up 25%, you take house money out? Like you need to have a rules-based approach to your portfolio if you're going to buy individual stocks. If you're
Right.
going to buy ETFs and just index your way for the rest of your life, that's fine. So a lot of people don't have actual rules.
Right.
They just go on gut or what they hear.
Right. And what's interesting, is that people also say that to me, like when they the latest drawdown in the market, we saw, tech take a hit and all that stuff. And right away, I get a couple of customers that call up because they say, I'm too nervous. I got to sell my NVIDIA. No. Slow down. You don't need to sell your NVIDIA. We own it for a reason. We've done our analysis. We understand what it does. The story hasn't changed. Yeah, the market's under some pressure, but that's a cycle that's not specifically to NVIDIA. So unless the fundamental story on why you bought it has changed, why are you selling it? In fact, the weakness you should use to buy it if you still believe in the fundamental story.
Absolutely.
Right. And so you have that. I have that conversation over and over. And as you have it and people get more comfortable with, kind of the swings in the market, they don't nearly get as anxious. But you have to make sure that the fundamental story hasn't changed.
Right. P.S. I think investors are getting smarter about this
Yes,
too.
I think
And
they
I
are
think
as
they've
well.
also seen how fast these cycles are moving, Kenny. We had that 5% drop in November. That was bought back in one of the third fastest recoveries in history
Yeah.
after a 5% drop. The bear market we had for a minute or two during COVID until the government helicoptered money. These cycles happen quickly. The rips happen quickly.
Right.
The dips happen
Because
quickly.
the technology makes them happen. quick.
Absolutely. You've been talking about that to me for years, but also individual investors see this happening. We
Yeah.
saw through data, whether it's from Schwab's retail Stacks Index or from VandeTrack, which tracks individual investors' purchases outside of their defined contribution plans. They bought the dip almost at every opportunity this year.
Yeah, I will say that the bulk of my customers, when the dip happened, would call me up and say, "Are we putting more money to work?" They were, because and that's a positive sign,
Yeah.
right? Let me ask a question because we're going to run out of time, but I want this view of you. Do you have a sense of what investors are worried about going into 2026? Because it is a midterm election year.
Yeah.
So are people suggesting that they're nervous about the midterm elections?
Yeah. Midterm elections are about third or fourth on the list. We just asked them that very question. What are you most worried about right
Yeah.
now? Number one, inflation. And
Yeah.
inflation's come way down,
Yeah,
but it is
but-
prevalent going back to the affordability word. Number two, geopolitical instability. Nobody feels like we're in such a hot place right now.
We're not.
And all you have to do is turn on the news and know that we're not. The third thing that they're worried about is bubbles in the market. And that's maybe they've heard enough of it. Maybe they've seen, a little bit of air come out of this one. Maybe they're worried that this is a redo of whatever, 1999 or
Right.
the railroad bubble, or pick your bubble, because
Yep.
there's always one or two over a decade or so. So those are the things they're worried about the most. But most people are optimistic. They're not expecting another banger of a 20% year. They're expecting reasonable returns. And I think that is good.
Yeah, but you know what's interesting? In January of this year, a lot of people are expecting a return to normal, reasonable, 10%, maybe 12% all in when you add in divvies, right?
Yeah.
And it's funny, look what's happened, right? The Nasdaq's up again, nearly 25%. The S&P's up 16%. The Dow's up, I think, 14%. So it's been a great year, different than I think what even I expected coming into it.
Yeah, and if you're not entertained as an individual investor, you're not watching the movie, because this has been extraordinary. The past 3 years
Yeah.
have been extraordinary, and there's been one wall of worry after the other.
Yeah.
But guess what? Market keeps turning up and to the right.
Yeah, listen, we have to carry this conversation on another time. I really appreciated you coming in and have it, and I'd love to do it with you again. But it is time, because it's the end of the podcast, and I always end with a recipe, which I know you love. So today I'm going to give you bay scallops in a black truffle cream sauce. They are delicious. This dish is one of my favorites, and this comes from the ground as much as it comes from the ocean, right? Bay scallops are small and sweet, and they're quick to cook. They're easy to ruin, though, if you don't pay attention. They're asking you for attention. Don't force it, just let it happen. The pan, you warm it up carefully, a little bit of butter and olive oil. You put the shallots in there to soften until they almost disappear right into their sweetness. The garlic follows that just enough so that the dish knows the garlic is there. Then you put the scallops in, you sear them. You want to hear the sizzle when you put them in there. And then you add a little bit of white wine to just lift the pan up and deglaze it. And cream moves it slowly into this thickening, calming sauce, right? Then you add the black truffle. That's where it enters quietly. You shave it thin. It warms right into the sauce, and that's where the earth kind of folds into the cream. It replaces the depth with some brightness, right? It's a whisper of white truffle oil that comes at the very end, not enough to dominate it, but enough just to finish it, to just carry it far enough that you get this delicious aroma. And then the green leaves of the Brussels sprouts add a richness and a balance to it that, well, listen, you can scan the QR code on the screen for the full recipe, and you can thank me later, trust me. That's a wrap for today's Trader Talk, but the conversation continues. Subscribe on Apple Podcasts, Spotify, Amazon Music, or wherever you get your podcasts. You got questions or topics you want covered? Email us at tradertalk@yahooinc.com, because we're always listening. Until the next time, stay sharp, stay disciplined, stay in touch, and take good care.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.
It's time for Yahoo Finance's Market Minute. U.S. stocks mixed here as tech hopes offset a growing list of political worries. Investors looking ahead to a slew of mega cap earnings, with the S&P 500 eyeing a fresh record close. While sliding UnitedHealth is dragging on the Dow, shares of the company plunging despite roughly meeting analyst estimates on earnings. The move lower comes after the Trump administration's proposal for Medicare payment rates next year failed to deliver the expected hike. And Amazon is digging its heels into online grocery delivery. The company plans to close Amazon Go and Amazon Fresh physical stores, converting various locations to Whole Foods markets. Amazon now planning to invest in opening more than 100 new Whole Foods market stores over the next few years. And that's your Yahoo Finance Market Minute. Scan the QR code below to track the best and worst performing stocks of the trading session.
All right, welcome to a new episode of the Opening Bid Unfiltered podcast. I'm Yahoo Finance Executive Editor Brian Sozzi. I'm continuing a little bit of a detox from talking about all things stocks and NVIDIA and OpenAI, because I just need to do it. There's more going on in the world besides all things tech. And I have a bit of a surprising guest here at NASDAQ in Times Square with me. That is Patrick McEnroe. Good to see you.
It's good to detox from, yes, this is a perfect way for you to detox. Yeah, because I know nothing about your world, and I'll try to educate you just a little bit about my world.
Well, that's funny you said that, because I spent the day yesterday warming up my voice. Of course, you're a commentator on ESPN for a long time. Who is the real you? I have grown up watching you on ESPN, especially around the U.S. Open. Love going to that event. I did not catch your playing career.
You didn't miss much.
No, come on, you reached 28. Like, who are you? Like, how should I intro you?
That's a very good question. You know, I've managed to be able to play a lot of different roles post-playing career. You know, I played until I was about 30. I had a shoulder surgery that put me out of commission. I just had another one about 3 months ago because too much wear and tear. But anyway, that kind of opened some opportunities for me in the broadcast world. At ESPN almost 30 years ago now. So I've sort of parlayed that and been able to do that for my whole career. And then I've been able to work with the USTA as the head of player development for a bunch of years, be the Davis Cup captain for the US for 10 years, the Olympic coach. And then now work with my brother at his tennis academy, the John McEnroe Tennis Academy, be part of the International Tennis Hall of Fame as the president. So I've sort of been lucky to work in a lot of different roles, but all kind of surrounding tennis. And then I also do my own radio show on Sirius XM. That's a little bit of tennis, a little bit of all sport. So it keeps me fairly busy, but all in the world that I really love, which is tennis. I started out as a kid just doing what my two older brothers did. I have another brother, Mark, who became a successful attorney. So he wasn't a professional tennis player like John and myself, but tennis was just part of how we grew up. And we were able to parlay that into a pretty good career post-playing for both me and my brother John.
Grew up in Long Island, right? Me too.
Well, I have to say Queens. But
okay.
It was sort of more like Long Island-ish, if you love where Douglaston is. It's right. Douglaston, Queens is right on the border of where my wife always gives me crap because she says, you're really from Long Island. My wife's from Long Island. We met at school, actually, at grade school in Long Island, Buckley Country Day School.
Wow.
But anyway, we lived in Douglaston, Queens. And my parents had started out, you know, with nothing. And my dad was an attorney, working during the day, going to law school at night. I mean, he wasn't an attorney yet. My mom was an emergency room nurse. And they got married quite young. And when they moved to this kind of nicer part of Queens called Douglas Manor, there was a tennis club there. And they went to my brother John, who was 8 or 9 at the time, and said, you could either try swimming, they have a swimming pool, or you could try tennis. Tried swimming for like a week, said, I hate it. He was a great athlete. He was already played soccer, baseball, basketball. So he tried tennis, and the rest was history.
How is it? I'm sure you've gotten asked this question like 5 trillion times, but like, what was it like competing in those early days with your brother? I mean, you're back there, you're practicing.
Well, it wasn't until I got to be about 16, 17 that we could actually play even with each other, because he's 7.5 years older than me, which he likes to remind me
I'm
of
sure he
quite a bit. So when I was a little kid, you know, I would just literally tag along with both my brothers, you know, playing soccer, playing basketball, football. And tennis, you know, people say, well, why did you choose tennis over the other sports? Because we did play all sports, played on our teams at school and so on. Well, we just happened to be better at tennis than we were in the other sport. My brother was a great athlete, a great soccer player. I was a decent athlete in other sports, but I happened to have a pretty good skill at tennis. So we stuck with tennis, and it helped us get into college, which was at Stanford University, which had a great academic history and also great tennis history. And our parents, you know, always stressed with us academics first, and then, you know, use the tennis to help you out there.
I speak to a lot of CEOs that lead public companies. They're titans of industry, and in their head, they all think they're athletes or want to be athletes. What did a prep day look like for you when you were competing for an event?
There was a lot of hours. I mean, I actually remember living in the city, and I'd be preparing to go to the Australian Open, which I'll be going to next week. So if I was a player, I'd already be there, because the warm-up tournaments are just getting underway in the early part of January. I remember going to play, going to practice. There's a bubble of courts right under the 59th Street Bridge, which in the summertime become like an outdoor, like where they play softball and stuff, and they're red clay, which is highly unusual to have in New York City. And I would go there at 6 in the morning, and I would train from 6 to 8 in the morning. I had a guy that would, you know, drill me, play with me, and I could get a court early before, you know, people that actually paid to come and play. So I'd usually do that for a couple hours. I'd go home, I'd rest, I'd come back, train again for another 2-3 hours, and then do your gym or do your fitness. And, you know, now it's become one of the reasons why you're seeing these all-time great players been able to play so long is they've used technology. They've used
like the stupid strap, this
well,
Whoop strap.
Yeah,
It's
you got
tracking
that.
my life.
Yeah, tracking your life. Yeah, you can't even have a drink.
No, I can't actually.
Right,
No,
right,
I can't. It throws off all the stats.
You know, it was when you're doing it just